Hi, and welcome to the Awakening series where we bring brilliant minds together. Today, we have an honored guest. His name is Daniel Byrd. He and I have been friends for many years, and I've been so enamored by his wonderful journey. I wanted to bring him on the show to give everyone some insight on the fourth industrial revolution. Here's a little bit about Daniel. Daniel is a financial consultant with Equitable Advisors in Colorado. In his role, he serves his clients by delivering perspective and insight around new industries and disruptive markets. Daniel brings his background in progressive organizations to create investment portfolios with exposure to the fourth industrial revolution. Daniel, thank you so much for your time today. I'm so thankful to have you on the show. It's an honor. You've been my friend for so many years, back in Denver, Colorado, our good old days. And I just have been a fan of what you've been doing for the past many years. Now stepping into the fourth industrial revolution, I really feel that the audience would get a great insight from your journey and really all the insight that you have to bring to the table. So thank you so much for being on the show.
Kimberly, thanks again for having me. Love the opportunity to share my story and some of my work, and happy to answer any questions afterwards as well.
Awesome. So if you can give us a little bit of insight about your what you're currently doing.
Yeah, happy to. So again, everyone, my name is Daniel Byrd. I'm with Equitable Advisors, which makes me a financial advisor by trade. But my specialty at the firm is investment strategies for new industries in tax shields. And that really comes out of some work I did a few years ago, developing the first of its kind stock index to track a composite of what a lot of business leaders call the fourth industrial revolution, or a collection of the most exciting areas of the new economy. And cryptocurrencies play a major role in that. What we do is use that index as a benchmark to build custom portfolios for households and businesses who are looking to invest in the space.
Awesome. Wonderful. Well, I know I've talked to you a little bit about cryptocurrency, and my first company, Advanced Learning Solutions, has done some innovative learning and development for some different companies. So I know a bit about it. I just would love to know a little bit more. If you can just kind of give, say, for example, the average person, your thought process on cryptocurrency and just the topic, at a higher level, but maybe also at a granular level as well.
Yeah, happy to give you my take on the basics in the whole field. And so we have some point of reference. Cryptocurrencies, or what some might even just call digital currencies, as the name would lead you to believe, is just a form of digital money. So similar to the dollar or the euro or the yen, but the key difference is in how the money is created. So with governments or like organizations, they're printing it, which you hear a lot of people have strong opinions on one way or another. But cryptocurrency, and again, digital currencies, you might call it, are created through a process called mining on a platform called the blockchain. And I think it's going to make a lot of sense to provide some context on the value of the blockchain and what that's bringing to the table. And without getting too deep into the weeds on it, the blockchain technology by design is a system that is very hard to edit by channeling, I would say, undesirable sides of human nature. Basically, we all are very self-interested, and it provides an incentive to call out bad actors in the platform or in the program. So if someone wanted to commit fraud, if they wanted to fake a transaction on the blockchain, that someone sold a Bitcoin to someone that didn't actually happen, or they traded what another big thing right now is the NFTs, maybe a piece of artwork, and someone wants to prove that transaction actually happened. If you go to the system of record for that, the way it's set up, the transaction itself is verified by a bunch of independent miners, they're called, but they are all incentivized to call out anyone who's trying to game or trick the system to run a fake transaction. And the way the incentives work, it provides enough incentive that it would be difficult. Well, it would be too expensive for someone who wants to, let's say, fake one transaction, even if it was for, let's call it $1 billion. The amount of money that they would have to pay in tokens to get the entire system to rewrite that transaction is more than the transaction's worth. So that's really the beauty of it, is it's an ideal system for handling any form of system of record. So that could be not just money, that could be voting rights, gun ownership, land ownership, copyrights, trademarks. But that's really where I see the power of something like the blockchain technology, and cryptocurrencies are a part of that story. But there's a lot of ways to invest across that whole industry.
Thank you so much. A housewife friend of mine asked if it would be too late to buy in at this point in time.
Short answer is no. Longer answer is it depends. As a financial advisor, I always have to qualify with that because every situation is unique. Even a housewife of similar age, maybe similar family obligations, might have much different attitudes towards investing in certain areas or different risk tolerance. But what it really breaks down to is which I'd call track of investing are you looking at. And when I say that, what I mean is there's different, I think of almost like racing tracks. There's different types of cars or driving styles that you'll use depending on what type of race you're in. And a good analogy, I think, for that too is bikes, in the way that you use different gears on different types of terrain. So with cryptocurrencies, people tend to fall into one of three camps. It's folks who are either, I would say, looking at the day-to-day price movements, kind of chasing the action. It's more gambling style investing or trading versus long-term investing. So that's one view or one track, one gear you can use. Another would be looking at the long-term value of digital currencies, of Bitcoin or any of these other coins, becoming what's called a normal asset class, the same as you would have the dollar or the yen, in that people are using it for other reasons besides just trading it, the value of the price on any given day or any given hour. So that's a different track of investing. And then the more broader view on investing in either, you could say, any cryptocurrency or any blockchain type project is looking at the ecosystem. So do we want to invest in, instead of investing in the price of gold, do we want to invest in gold mining companies, or in this case, crypto mining companies, or semiconductors, the groups who make the chips that go into the servers that run all this processing. So as you move from that more speculative, chasing the action side of investments to more of the long view, we're looking at investing in the broader ecosystem. You generally take on the shorter end, you have more risk, but you have more return. Or there's more chance of upside, but you also see the price drop like a rock. And then when you're looking at the ecosystem, you don't see as many wild returns, but it is above market, meaning that it's producing right now, it's returning more and showing more gains than if you just threw the money into, let's say, the S&P 500.
That's awesome. Okay, that's wonderful. So how does one go about investing? Where do they go? Do they connect to their bank account? And do they buy a coin? Do they invest in, and where do they go to research also, I guess, the coins or,
Yeah, no, those are fantastic questions. And really what I think it boils down to is it's a timing question. And there's two pieces to this. The first is when do you need your money back? So this money that you're investing, is this money that you weren't planning on touching for 20 years, or is this money that you needed in 18 months for a down payment of a new home? So that's the first big thing we need to figure out. And then the second is, what's your intention for the trade? And when I say that, especially in cryptocurrencies, a lot of people, this year or back in 2017 got really excited by all the headlines and just wanting to, the FOMO of it all, of wanting to make sure that they didn't miss the next big thing. But if you're playing that game where you're trying to get in, catch this huge upswing, and then get out before it drops, you would use a different set of funds, I would say, than you would if you were investing in the companies who are making all the infrastructure that this all lives on. That's more of a long-term bet. So let's say, for example, you're doing some of these really short-term trades. A lot of times that's done in what's called like a non-qualified or a brokerage account, versus if you're taking a longer view, you don't need the money back for 10, 20 years. I would use something like a 401k or an IRA, maybe even a Roth, to make those longer view investments versus the ones that I'm getting in and out of, because the taxes on those get deferred if you're using it in these other accounts, which at the end of the day, because of compounding, it has a really big effect on your account balance if you can leave more money in there without touching it, versus money you're using in Robinhood, or Coinbase is another platform where you can buy some cryptocurrencies more or less directly. Technically, you don't own them, in the same way that when you buy certain gold investments, you don't actually own the gold. You own something that represents the price of gold, similar to that.
That's awesome. That's great insight. Thank you so much. As far as kids, today, like say, for example, I'm a parent and I want to invest for my son. I mean, I think I was told, or maybe you mentioned it last time we spoke, that kids have wallets. Is that something that we spoke about?
Yeah, it's funny with a lot of my clients who are interested in cryptocurrencies. While they're just getting up to speed on it, their kids are fully bought in. They have their own wallets, they do their own trading, and that's largely because a lot of it's designed to look and feel a lot like online gambling and gaming. It does, it has that built into the design, but what that means is that you're going to have this whole generation of people who are already familiar with this, investing in and around this asset that today is very speculative, wild price swings on any given coin, but over time should mature into something much more steady Eddie, I guess you could call it, with more predictable returns, with more predictable patterns, that looks and feels like all of the boring financial world investments that we have today. At some point, that's where we'll get. But for now, because you also asked about when would be the, what's the right way to start investing into the space, when, how much. And it's funny, for a lot of households whose kids, the kids have their own wallets and they have their own coins, or they're doing their own trading and gaming it, kind of almost like maybe fantasy football in that way. I think it's worth for the household to take into account, okay, you already have someone who has some, you could call it expertise in this area with some exposure for the house. So let's count that in your total picture, because at this point, for any given household, I would be hard pressed to recommend anyone have more than a few percent of their household portfolio invested directly in cryptocurrencies.
Wow.
It provides some wild card returns. You don't know where it's going to land. It doesn't always behave or act in relation to other assets in the way that we see, like stocks work to bonds, or we can't define those relationships yet. So it's good to have that spice in the mix, but I wouldn't have it be overpowering. So for anyone who's investing directly in cryptos, it shouldn't be more than a few percent, which is fine, because if you have these crazy returns like you're seeing, especially over time, on the average, that'll still be higher than you get in the market. So it's good to have that. But if you're trying to invest in it in other way beyond that fantasy football or kind of Vegas style investment strategies, then there's other ways to do it using other types of accounts.
Awesome. Very cool. Thank you. So a quick question, more of a personal question, but what would you give yourself? I mean, as far as advice, like 10 years ago, would you give yourself, different advice? Or would you be doing anything different since you've been in this line of work for a while and now you know what you know?
Yeah. I would say, and I did write down just some good kind of rules of the road. I mean, a lot of this is going to be standard issue 101 financial advice, but if you can maintain a discipline around this, that would probably be the first piece of advice. If you can set up a level of discipline for the different types of investment that you're comfortable with, that's probably going to help more than anything, especially if you're doing it on your own versus working with an advisor, so that you're just not making too many emotional decisions, doing the opposite of buy low, sell high, right? You're buying high and selling low, which tends to happen in stress times. Saw a lot of that. Well, I advised against that for a lot of clients last year. Height of the pandemic, my account's taking a massive beating. What do I do? Do I get out now and try and depending on where you're at timing wise, when you need the money, is one of the other big factors. So if it wasn't something you were drawing down now, there's no reason to do any type of real emergency triage. No reason to pull that money out when you don't need to. And for a lot of people, they get lost in the emotion of it. So I would say having discipline for yourself is the first step. And then, like I said, some kind of tried and true financial advice. Spend less than you make. Penny save is a penny earned. And the best time, this is also something I shared on my networks last April. But there's an old saying in finance. It's from an old European banking family called the Rothschilds, and it went, the best time to buy is when there's blood in the streets, even if the blood is your own. So even if you're the one who's feeling the pain from it, look through the storm and stay the course through the storm. That's what I was trying to say. Stay the course and don't be afraid to take on risk when everyone else is running. So when the market, follow contrarian buying signals. When the market's really down, that's a great time to buy if you've done enough homework on what you're going to invest in to begin with. That's the other piece. But if you've done that, then the best time to buy is when the markets are down, and the best time to sell is when everything's looking like it's going through the moon or it's going through the roof.
I love that advice. Thank you so much. That's huge. Very, very cool. As far as what we have or haven't discussed, would you like to touch on another topic?
The only other thing I'd say that's really important to consider when you're just looking at general financial planning, and then how it does relate to cryptocurrencies, because there's been a lot of statements that came out of the IRS around this, is tax treatment, and in understanding how that's going to impact not just your cryptocurrency investments, but your overall portfolio. So that as you're looking at putting together different strategies over time, so you might have one strategy to build cash reserves for a down payment, which is different than a strategy you're going to have for educational savings, which is different than what you have for retirement. That along the way, there's tax implications on a couple of different levels across those. And that if you can navigate that side of it, that will set you apart from an amateur. That's what sets apart professionals from amateurs more than anything, is understanding not just what we call asset allocation, but what's called asset location. So what tax code is it located under, not just what investments it's in.
Oh, wow. Yeah, we don't always think of taxes when we're, investing, but you're right. I love that. That's a good point. Thank you for that. So where can we find you? I'm sure a lot of people will seek your advice. Daniel, where can we find you?
Yeah. Best to catch me on my compliance approved platform, which is LinkedIn. So feel free to connect with me there. I also, well, actually, yes, compliance approved. That's the one I'm allowed to point people to outside of personal social profiles, as well as I'll share this out if I haven't already. But I do have an overview website that has a summary of the fourth industrial revolution, outlining where we sit historically and some of the precedent that we've seen before, and why something like the fourth industrial revolution presents a unique opportunity to create the next generation of old money.
Awesome. Okay, so one last question. It's a bonus question.
All right.
What is your outlook in regards to the disruptive markets now through 2024, for example?
Sky's the limit. No, there's just so much. There's so much upside in so many different areas. For me, and you'll see this in the website as well. Some other areas I focus on are pharmaceutical cannabis, industrial hemp, 3D printing, new uses of solar in advanced computing. And across the board on all of those, you have large players, small players who are not just involved today, but have been for several years. And I think similar to what we saw happen with the social media space, where 20 years ago, no one knew who Facebook was. It wasn't a company. And I think you'll see comparable stories to that develop over the next few years, where there'll be companies in 2 years that are household names that weren't even someone hadn't even thought of, right? There'll be new companies that for any of the ladies listening that your kids may end up developing, right? Because a lot of especially in the blockchain space, a lot of the developers are in their teenagers, and the pioneers are teenagers. So it's really it's all very forward looking, but it's at the same time we're still in the Wild West stage for a lot of these industries. So there's a lot of, I mentioned earlier, there are a lot of bad actors. So you just have to be mindful and exercise a lot of discipline and due diligence before you pull the trigger on anything.
That's awesome. Daniel, this has been such a pleasure, a great insight. I really appreciate you. It was an honor. Thanks so much for being on the show. I do appreciate our friendship, and I look forward to speaking to you again.
Fantastic. Well, great catching up with you again. And yes, please, anyone who has questions, even just very general purpose financial advice, happy to share what I know.
I'll have Daniel's information below. Thanks, Daniel.